Hello, welcome to today's edition of the Final Bar. Market's selling off today, so we've got distribution on Friday. This has been a pattern for the last couple of weeks. Relatively okay week, and then Friday is when things start to taper off a bit. So we'll talk about today's sell-off, what it means relative to the long-term trends. With the S&P, it's all about whether or not we continue this pace of higher highs, higher lows, or sort of reverse lower. So we're going to dig into that a little bit. Also answer your questions from the Final Bar Mailbag. We're going to wrap the week. Most importantly, the goal of the show is to connect to the long-term trends, and that's what we'll be able to do when we do our weekly wrap, focusing on the long-term trajectory of the markets. Ladies and gentlemen, this is the Final Bar. Hey, welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining me today, every weekday after the close, to look at today's price action from a technical perspective, connect it to the long-term trends. And Friday, more than ever, we like to take a step back, look at how the week has evolved, how that connects to the longer-term trajectory of the markets. Today, obviously, we've got quite a bit of distribution, a lot of interesting themes sort of to unpack together. We'd had sort of a constructive week yesterday, starting to falter, and all of a sudden we get this follow through. So what does that mean for the long-term trend of the markets? I was speaking last night to the CMT association here in the Seattle area, and we talked as a group a lot about sort of the warning signs that we've talked about on the show for a couple weeks now: the divergences, the weakening breadth, the sector themes, the leadership of technology, how that rotates. So hopefully today we'll be able to spend some time unpacking all of those relationships based on today's close, the weekly close. Let's get into what's coming up here on the show and also on StockCharts TV. There's a lot of really good content coming your way. On Monday, we have Craig Johnson on our Behind the Charts episode. Craig's from Piper Jaffray in Minneapolis. Really cool conversation we had with him. On Wednesday, the 26th, Julius DeKempener, the sector specialist, will be sharing his insights on sector rotation. And then on Thursday, the 27th, we'll have Axel Kabar. Axel's a Bulgarian technical analyst. So always interesting to hear from someone who's disconnected from the market you usually look at. Always some interesting perspectives there. After that, Scott Smith on March 3rd. And then on March 6th, the Final Bar is going to be going on the road. We'll be heading to New York. We're there for the Traders Expo. We're going to be capturing some really good conversations with technical analysts, strategists, market experts that we meet at the Traders Expo. So we look forward to having those conversations and getting them ready to share with you in the coming weeks and the coming months. Actually, some really exciting news from the Final Bar. We're going to have some guest hosts that are going to come in and share some market insights along with me during that time when we're on the road in New York. So a lot of really good content coming your way in the coming weeks. And if you miss any of these episodes, just go to our YouTube channel. You can watch them all on demand later. Let's take a look at the market recap. So when we're thinking about the market recap on a Friday, it's interesting because you're able to lock in today, you're able to lock in the week, and then you're really able to take a step back. So on a Friday, what we like to do is recap the markets here, and then we'll wrap the week and do a little more of a longer term look at some of the themes. But today was pretty destructive, and again, it felt a lot worse than it probably was because we haven't had a lot of down days. The last 2 days, we've had quite a bit of distribution. This is the last 2 days on the S&P. You see the big distribution we had going into the lunchtime hour yesterday. Today, it sold off right out of the open and just sort of continued to dribble lower. The S&P finished off over 1% heavy for the day. The NASDAQ down even more, almost 1.8%. Mid caps and small caps all down about the same amount, so there wasn't really a cap tier theme to speak of. It was really more of a broad-based sell-off across the equity space. This sell-off pushed the volatility index, the VIX, or the fear index, up above 17 now, 17, 13 at the end of the day today. Looking at sectors, you had the defensive sectors at the top, real estate, consumer staples, followed by healthcare, then utilities. On the bottom, though, and this is where the negativity really came from, you had technology, consumer discretionary, communication services. So this has been parts of the market that have really been the leadership, especially tech. And now you see them at the bottom of the list, really selling off fairly dramatically here. What does that mean for the chart of the S&P? And again, I mentioned in the intro, I spent some time with the CMT Puget Sound area chapter here in the Seattle area, and it was a fantastic conversation last night talking about market themes and really talking about my process, how I think of things. But we looked at a lot of charts together, and this is one that we spent a little bit of time on, just thinking of these divergences. And it's funny, when you talk about the bearish divergences with higher highs in price, lower peaks in RSI, I mentioned last night, divergences like this is the kind of thing that has called like 10 of the last 4 corrections, right? It tends to give a lot of signals, especially in an extended bull market. You'll get these divergences. Some of the time they will be confirmed and the market will distribute afterwards. Sometimes it just needs to digest it and go further. And if you look at a chart of gold, which hopefully we'll get to in a minute, you'll see that it's sort of had that situation where we've had a bearish divergence a couple times in the last year, that it's sort of resolved higher. It's sort of invalidated that sell signal and sort of gone up. But again, this is the kind of thing, this is the warning sign that puts it on my radar, and it's all about following what happens next. So for me, again, 2 things I would tell you. On a chart of the S&P, it's all about the peaks and the valleys. And we've had this pattern of higher highs and higher lows in price. Until that pattern breaks, the trend is up by definition. So even though we sold off the last 2 days, we're nowhere near the lower end of this channel, nowhere near the previous lows. With 32.10, I think is really the main line in the sand as a long-term investor I'd be looking at. But there are a couple sort of skipping steps along the way. The first would be 33.20, which was the low from, this is sort of the end of 2 weeks ago, beginning of last week. This is that Monday session that rallied very quickly. So, looking at the lows there, I think would be step number 1. The 50-day moving average around 3,300 or so, 3,280 or so would be the next sort of level. But again, those would be short-term swings. The main level I've been looking at for a while is this 32.10. That's sort of where it's aligned with that horizontal line. Also interesting to watch the RSI, right? If it breaks down through the previous low, that would sort of suggest a follow-through to the downside. In terms of the other themes, you saw again a return of gold miners and mining stocks. These were the top groups yesterday. You can see you certainly had follow through. Gold that rallied very significantly today, along with bonds. And so, miners have been now at the top of the list. You also have something like tobacco, which has not been on the top list for quite a while here, bubbling up here, coming out of a position of weakness. But again, groups like this that are starting to emerge, that had been out of favor, starting to emerge, potentially starting to outperform, as they certainly got a help for that today, would be interesting to watch. On things that were down, you had a lot of energy, and again, energy, one of the weaker spaces. But what jumps out of the page at me is semiconductors. And one of the things we look at a lot is the relative performance of the semiconductors group, because it tends to be a good leading indicator for the overall market environment. When this group tends to do well, the markets tend to be in good shape. What's happened here, again, even though the relative strength pulled off, it's still overall doing just fine. This was 1 day. Again, you want to look at 1 day, 1 week relative to a longer-term trend and see what this means. Overall, it tells me we're getting toward the lower end of this trend. If I would make a regression channel using the last 6 months or so, we're sort of getting in the midpoint, heading down to the lower end. That's okay. I'd be looking for that lower end, looking at a trend line connecting these lows, looking at the 50-day moving average. If it breaks down through there, if the relative strength continues to roll over, maybe new relative lows for the last couple months, I think that would tell you a bit of a change of character of the market. At this point, it's just the beginning of something, right? It is noteworthy, though, this is down almost 3%, almost 3 times the downtrend or the down move today from the overall S&P 500, from the overall market. That's our quick market recap for today, and a lot of distribution. Obviously, there were areas that were up, so if you missed some of these names like Gilead and others that had nice rallies, it would be interesting to look on a down day. I always like to look at the stocks that are up a lot, because that shows you where you have some divergences, right? If everything's down, what actually held up okay? Those could be some interesting names to pay attention to. Look for some potential canaries in the coal mine, if you will. Let's move on to our next segment, though, which is the wrap of the week. So every Friday, we like to take a longer-term view at the market environment, think about it as a long-term investor. And again, One of the things we talk a lot about in the show are routines and connecting the short term to the long term. And Friday is the time to do it over the weekend. Is a great time to take a step back. So we're going to use the Mindful Investor Live chart list for this for a lot of the way. If you've not gotten to this, if you've not seen this before, go to the Mindful Investor blog on the articles tab here. Go to my blog, and you'll have a link at the very top to go to this chart list, which you can install on your own account. We're going to start with the long-term market trend. So again, remember this distribution that we felt over the last 48 hours is a little tiny blip on this long-term trajectory of the market. So let's keep things in proper perspective. Overall, the long-term trend has been positive. And the signal I'd be looking for is here at the bottom. This is the weekly PPO, or the weekly MACD is very, very similar. And this is showing you sort of the medium-term or the intermediate-term trend in the S&P 500. Until we get a sell signal where it breaks down sort of what we saw here at the end of January of 2018, that's when it tells you the uptrend is starting to break down. We have not had that yet. It's still in bullish territory. So we would need to see more of a sell-off for that to really register as a negative sign from that longer-term view. We've looked at this chart a lot recently. This is looking at the breadth along the cap tiers. Again, today we had a situation where sort of everything came off. It wasn't like small and mid caps were up while everything else was down or anything like that. Everything sort of sold off in a very similar fashion with some exceptions. But overall, these breadth readings will most likely turn lower. Overall, I think we'll still be in a position of caution. But just based on what I'm seeing at a high level, it appears that the long-term breadth on the largest companies remains the strongest. I don't think that would change in any way based on what we saw today. You know, it's been interesting looking at the new lows on the market. This is the New York Stock Exchange. You can see that we've had a token number of new lows. That was different from sort of December, January. This 2-month period, we had almost no new lows and no new lows on the S&P 500 for most of that period. All of a sudden, we started to see an increase here in the end of January. That's when the market pulled off a little bit. Started to see some companies start to break down. And again, it's energy and some other defensive things. But, you know, again, it had been a situation where nothing was breaking down. Now you started to see a bit of an increase. So we've had some, not a ton. And on the S&P, it's been, essentially zero. Most, if not all, S&P names remain making new highs or not making new lows is what's most important. It'll be interesting to see if and when we do see a deeper correction, how much we see an increase in new lows, because it's been a while since we've had a meaningful number of new lows on the S&P 500. We haven't looked at this chart actually in a little while. This is looking at the percent of stocks in the S&P 500 that are above their 200-day moving average and above their 50-day moving average. It's interesting that with the sell-off this week going into Friday, still 2/3 of S&P names are above their 50-day. So, that had peaked out just above 80%. It was around 85%. It got above 90%. At the beginning of last year. So overall, it's been much more elevated than it was recently, but still, 2/3 of stocks are still above their 50-day. So, again, it'll be interesting to see if we see a follow through next week, if you see the S&P go lower, go below its 50-day, how many stocks are also going below there. And it's rare that we've been relatively weak in this indicator for quite a while. It's been fairly elevated. 4 out of 5 S&P names are still above their 200-day. There's a long way to go. If you look, the S&P would have to go below 30, 40 to break its 200 days. So there's a lot of space there. It's actually very extended relative to its 200-day moving average. The concern there, along with the bearish divergence, is if you look back at times when it's been this extended, it's something like the beginning of 2018 where you got so far away from the 200-day that it felt like we had to have a reaction sell-off and come back down to earth, if you will. So, again, it's just the early days of a potential pullback, but interesting to see how this is lining up with some of the previous peaks that we've had. In terms of sentiment, the AAII readings really didn't change a whole lot. We didn't talk about this yesterday because it wasn't much of a factor, I don't think. Similar number of bulls that really didn't change. It's about 40% of respondents still bullish on the S&P. An increasing number of bears. So all that means is some people went from neutral to bearish, but just a couple percent. So overall, remaining in a similar sort of situation where definitely more on the bullish side than the bearish side, which is, again, actually consistent with a lot of healthy bull markets. It's not really giving you a warning sign of extreme bullishness by any means. One of the interesting charts I would think about in terms of sector rotation, we're going to rotate to that here in a moment, is looking at the consumer space. One of the charts we talked about at the CMT meeting last night, it's interesting how this ratio, looking at the cap-weighted consumer discretionary versus staples, has gone up pulled up back a little bit today for sure, but this is really weighted towards Amazon dominating consumer discretionary. If you take the weighting of Amazon out of there, it's actually kind of a meh, kind of leaning more toward the defensive side of the ledger, but really has been flat for the last month or so. So this is consumer discretionary relative to consumer staples, equal weighted, so it's sort of equal weighting all of those names. So this tells you the average staple stock has been outperforming the average consumer discretionary stock year to date, and that trend still remains leaning more towards consumer staples. Feels a little more defensive than offensive, in my opinion. You know, looking at the weekly RRG, I think it's interesting to see a lot of pretty severe moves. You can see technology, the XLK, remains by far the strongest out of all the readings. Other noticeable movements have been utilities and real estate, which are accelerating to the Northeast. And again, in general, things going to the Northeast tell you there's an improvement in relative strength. And those are the areas you want to tend to look for opportunity. Interesting to see consumer discretionary, but again, that's a big weight of Amazon that's pushing that higher right now. On the downside, you see healthcare that had been one of the top sectors rotating down into the weakening quadrant heading southwest, which is more negative, and financials have now completed the transition down into the lagging quadrant, down with things like materials and energy and industrial. So really following through on that issue. One of the questions in the mailbag, if I remember, was relating to banks and just what, you know, the participation of banks. And certainly we've seen the XLF not participating as much on the upside, and now based on the RRG work, really completing that transition. So we've had a bit of rotation, but it's interesting to see technology remaining pretty strong. Now, again, this is based on longer term weekly data, so it'll take a little while for a sell-off in tech to be registered on a chart like this. The intention here is to keep geared toward the long-term trends. The last thing I'm going to look at as part of our weekly review, and again, as always, I feel like we could spend so much time with all of these, so I'd encourage you to use this as an inspiration for a deeper work that you can do over the weekend, in the evening, whenever you have a good opportunity. But I like to look at the scooter reports, look at the industries, look at the 1 week changes, and first we'll look at the strongest sectors. So at this point, automobiles, this is Tesla's group, computer hardware, that's Apple's group, if I remember right. Software, so it's a lot of tech. Home construction has the home builders in there. Semiconductors, one of the top 10. So still, even with a bit of a pullback, holding up very nicely. But let's look at what's moved over the last week. The big story, I think, are the gold stocks, the gold miners, the mining names. When we look at the chart of gold, you can see it's broken out significantly. Could be a safe haven play, absolutely right. But certainly in a situation when everything has been in an uptrend, something has to disagree, something has to change. And today and yesterday sort of feeling like equities potentially being the weaker option, something where we're going to see some weakness. I'd also encourage you, we don't have time to go through the ones that are down, but a number of healthcare spaces in here, also some industrial, so defense, aerospace, some household products. This is within staples. So make sure you look at those names, and if you have exposures or if you're looking at those groups, make sure you're aware that there's been a lot of negative movement relative to the other industries out there. That's our weekly wrap for a Friday afternoon here in late February. We're going to take a quick commercial break. We're going to be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hey guys, welcome back to The Final Bar. I'm your host, Dave Keller. Please keep your questions, your feedback coming to us, thefinalbar@stockcharts.com. It's the best way to get a hold of us at any time. We're going to open up the Final Bar mailbag here in a moment, answer some of your questions. So keep them coming, and during the show, just go to the Q&A panel on the screen and put anything you like. We actually had a poll running, and we always have a poll up on the StockCharts TV screen. So if you have missed that, it's usually on the right side of the screen. There'll be a poll running. We kind of refresh those every couple days. We love to get your insights on what you're seeing. We'll ask a lot of different questions. One of the questions we asked this week: how frequently do you check the value of your stock and mutual fund investments? I thought it was interesting that 3 out of 4 of you that responded, this is out of hundreds of respondents, said you check it every day. 14% said a few times a week, and then tapering off from there. So How would I react to this? To be honest with you, the question you should ask yourself is, what is your investment horizon? How are you trying to operate? And my argument to many of you, some of you may be short-term investors, in which case checking your portfolio every day makes a ton of sense. But if you're a long-term investor, wow, consider the value in not paying as much attention to your portfolio and paying as much attention to other things, and then having a regular process where you review your holdings. If you get so caught up in your own positioning that you forget to have a better market awareness of what's going around you, what happens a lot of times, you get exposed to some of those behavioral biases like endowment effect and others that can get in the way. So my caution to you is just remember, be wary about how often you're checking your portfolio. You don't need to check it that often. Even if you're not looking, things are probably working out okay for the most part, as long as you have some good lines in the sand to pay attention to. So let's get on with some of your own questions. So we had a number of questions that actually came through. We're going to start with a couple different questions related to let's see, the first one, the difference between buy-side and sell-side financial institutions. So this was a question we had. There's an article that someone had sent me about the need of the financial industry to recognize some assets for collateral and what that means. And it talked a lot about buy-side and sell-side financial institutions. So what does that actually mean? So just as the quick 30-second version of it, you have buy-side institutions, which are asset managers like a Fidelity or T. Rowe Price or something like that, pension funds, insurance companies, all those sorts of things. People that pool up a bunch of assets and try to invest them would all be considered buy-side. Sell-side would be the financial institutions that are meant to help the buy-side. So bringing companies public and then market making, keeping the industry functioning well, bringing companies through the IPO process, secondary offerings, all of that. So those would be the big banks, things like Goldman Sachs, UBS, others. What's super confusing is that some institutions actually have both a buy-side and a sell-side arm. So they'll have an asset management arm and actually a brokerage or an investment banking arm. That's changed a lot in the last 20 years as a result of the whole financial disasters and everything in the 2000s, 2010s. So the broad summary, why they're called that way, the buy-side institution tends to be the buyers of assets. The sell side tends to sell the assets to the investors. So that is the quick answer. I hope that's not super confusing. And sadly, with a lot of financial topics, they get really confusing very quickly. So I hope I can try and make it easier for you. Second question was related to an interview we had with Eric Balchunas from Bloomberg. That was on Behind the Charts. I think this Monday we ran that episode. We caught up with him a couple weeks ago. He was asking, we were talking about ETFs and some of the concerning structures. One of the things we talked about was leveraged ETFs. And I don't have time to read the whole question, but the question was, too many people seem like they're anti-leveraged ETF. In my opinion, they might not have done their homework as much. There are plenty of times when leveraged ETFs make sense. So interesting point. I will tell you maybe two ways to answer that. Number one, I think the biggest challenge with leveraged ETFs, along with many ETFs, is a lack of understanding, right? So you haven't done your homework, as you alluded to. You're not aware of the exposure that you have, and as a result, there are a lot of unintended consequences, right? So something happens, the ETF reacts to it. You wouldn't have expected that because you really didn't understand what might have happened. It's a common issue with a lot of ETFs, and especially non-ETFs, exchange-traded products, ETNs, and unit trusts and other sorts of things. I would say with leveraged ETFs in particular, they were designed to be short-term instruments. They weren't designed to be held over longer periods of time. And the way I would tell you is this: leveraged ETFs, for the most part, are meant to match the intraday, the current return. So if a stock is up or a market is up 1%, a double leveraged ETF should be up about 2%, and an inverse leveraged up should be down about 2%. So intraday, they will match the percent returns very, very well. But the moment you hold it more than a day, those percentages will disconnect. And that's why sometimes you'll have this weird scenario where a bullish and bearish gold ETF will both be going down. And that makes no sense because you're thinking, well, hold on, isn't one of them positive, one of them negative? But when you put the leverage in there and you're doing it on daily percent returns, they become disconnected. So the return profile might be fine. The returns might be compelling, especially on something like semiconductors that have been on such a run. You would have done much better owning a leveraged ETF to the upside because you would have gotten an exponential amount of that growth. The problem is when things start to change, when things start to fluctuate, it gets really hard to match those returns. So it's unexpected is the challenge. Question three, and we're going to go quickly through the rest of these. We had Jim Smith on a couple days ago as a GAN analyst, and he talked in one chart about gold related to planetary movement. So the question was, should there be a causal link between the two variables, or how are planetary movements related to charts? certainly outside my scope of understanding and my awareness. I'm not going to try to answer that question, but I will tell you this. If there's one thing I learned over my career, it's to always be open to new inputs. And before I question their predictability or their value to the investment process, I like to look at the performance of it and understand it, and then start to ask questions a little deeper. So it was a great conversation with Jim to sort of see how we approach it, how he had a read on gold. For me, I mean, the way I would summarize it, having looked at a lot of charts that incorporate some sort of planetary something, I will say that it's interesting where a lot of times it ends up being a really good money management exercise. And I found for most investors, especially technically oriented investors, having levels at which you revisit your position using good money management skills, regardless of how those lines are derived, can add value. And that's where I think it can be pretty interesting. We'll maybe dig into that a little bit more. Two more questions, and we're going to go to my chart here. This next question was about valuations, looking at the PE ratio on the S&P 500. So this chart, we have the S&P related to, so this is the PE ratio on the S&P going back to the last 5 years. We have the S&P 500 price and the earnings on the S&P here at the bottom. So this is the EPS, this is the price. So this ratio is basically dividing the P versus the E, and that what derives the price to earnings ratio. The question was in particular, is it concerning that we've gotten back from a valuation perspective to where we were just before the lights went out here at the beginning of 2018? Yes and no. So yes, the valuations are elevated at PE above 25. That's because earnings have been relatively flat, coming off a little bit, and the price of the market overall has gone up over the last year. That's what will cause the valuations to increase. But is that necessarily a good or bad thing? I can't really say that that's true, and I'll tell you why. If you look at our historical chart gallery and look at a really long-term view of the price to earnings ratio, so this is that same ratio going back to 1926, you can see that we've actually been way above that upper band, way above a PE of 20 for a while now. So even though we're at the upper end, we've been elevated for quite a while. So it's all about where we're at in valuations relative to where we've been. The challenge we have right now is the valuations can remain elevated relative to those historical trends for quite a long time. It doesn't necessarily mean that the market's overheated. Also, not to get too much into it, but the PE ratio can change for a lot of reasons, right? Number one, the price, but also the earnings that could stabilize or go down. So thanks for that question on PE ratios. We need to wrap up that mailbag, but boy, these are getting some really deep, really thoughtful questions, and thank you so much for that. So shoot an email to finalbar@stockcharts.com. We'd love to answer your question next time. We need to wrap the show very quickly and go to the 3 and 3. It's actually going to be the 3 and 2 today, but we're going to do it. Number one is gold. This is the GLD. As I mentioned, gold rallied very quickly today and really followed through. And again, this is a chart we've looked at. Hopefully this is not a surprise, this repetitive pattern that we've talked about with the rally, the pullback, the acceleration, the divergence that was invalidated. We had that same 5 steps here in the last 6 months. And don't look now, it's following up to the upside just like we sort of talked about. So it's sort of following a playbook and making sense to me. What's interesting right now is looking at gold and gold-related ETFs and where they are at relative to the extreme overbought region. An RSI above 80 tends to suggest a short-term pullback, but then a resumption of the uptrend. So overall, gold setting up very, very nicely. Chart number 2 is the TLT. This is the long bond ETF. As we've talked about before, we had this really descending triangle that, sort of non-traditionally broke to the upside. It actually resolved higher, which is unusual. Usually something like that would resolve lower. This ended up being a bit of a continuation pattern. We broke above trend line resistance. We then retested the previous highs from last August. And as of today, we have followed through in 2 days and really pushed to new highs. So the TLT to new highs, looking at the asset allocation of stocks versus bonds versus commodities versus the dollar, bonds and gold actually rolling up very, very nicely, performing very well over the last couple weeks, while stocks now faltering a little bit. Again, that could be just the beginning. That could be just a little bit of profit taking before a continuation, but it's certainly a chart I would be looking for to see if we see further upside there in bonds and thinking what that means for your own asset allocation. The last chart is consumer discretionary versus consumer staples. We talked about this a little earlier when we were wrapping the week. And again, I would just say the overweight to Amazon has been making this ratio maybe seem artificially constructive. If you look at the equal weight version, it's really been suggesting that the average consumer staple stock has been doing better than the average consumer discretionary stock. That doesn't tend to happen in raging bull phases. That tends to be more of a bear market configuration. So a lot to think about on those 3 charts. And to wrap the show, a lot to think about going into the weekend and into next week. Every weekend is when I tend to go through all 500 S&P charts. I don't know what your weekend routine is, but I hope you have some time to do your own thing, but hopefully some time to revisit what you're thinking technically, get ready for the next week. Next week, we have a lot of really good content, starting with Behind the Charts on Monday, 1:30 p.m. Eastern, so make sure you check that out. You can look up all of our previous episodes on our YouTube channel for StockCharts, so check out our previous episodes there. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend.